Is Datadog a buy? 5x return in 3 years. The high valuations of growth and momentum stocks are collapsing all around us. Only a few stocks have escaped the wrath of the market, and Datadog, DDOG, is one of them. Since its IPO, Datadog has been a Wall Street darling and investor favorite because of its extraordinary ability to beat and raise in every single quarterly earnings announcement, keeping sentiment on the company high and relatively immune to recent drops. Check the link in the description to get up to a $250 sign-up bonus with BlockFi and 9% per year over your crypto assets. For those unfamiliar with the organization, Datadog is a monitoring and analytics firm. Its backend software enables IT departments to monitor the health of internal systems, manage performance, and detect network anomalies. It was a newcomer in the market, fighting against New Relic, NEWR, a considerably larger competition. Datadog has surpassed New Relic to become the largest and fastest growing vendor in the infrastructure/application monitoring industry. Even with a recent bite-sized dip from highs, Datadog's stock has nearly quadrupled since the start of the outbreak. The dilemma for investors today is, which way is Datadog heading, and is a correction still due for Datadog when other high-profile trades like Palantir, PLTR, are collapsing? I'm still pessimistic about Datadog. The stock's ultra-high valuation, in my opinion, has no place in today's market, as investors are heavily favoring value and dividend stocks while avoiding last year's top tech buys. In my opinion, Datadog's recent relative outperformance versus other growth stocks will soon catch up to it. First and foremost, Datadog's basics are outstanding. This is a company that continues to expand revenue at a rate of more than 70% year-over-year while generating positive pro forma operating margins and free cash flow. You won't find a better combination or balance of hypergrowth and profitability in the tech sector. As a result, there is ample justification for its high price. But how much is excessive? Datadog has a market valuation of $44.87 billion at current share prices approaching $144, making it larger than some of the smaller members of the Dow 30. Datadog's enterprise value is $44.13 billion after subtracting $1.47 billion in cash and $734.6 million in debt from its most recent balance sheet. Meanwhile, Wall Street analysts estimate Datadog to produce $1.41 billion in revenue in fiscal year FY22, plus 42% YY, data from Yahoo Finance. Despite the fact that Datadog is a younger firm that started tiny, we expect that its sales will be 50% higher next year than consensus estimates for New Relic's revenue. That's a startling multiple. It's a higher revenue multiple than the S&P 500 is trading as a multiple of GAAP earnings, which is my go-to indicator for when values have gotten out of hand. Only one stock in the software sector trades at a higher premium than Datadog, and that's Snowflake, SNOW, which has a 42x revenue multiple right now. The simple line is that Datadog's story has stayed the same: high price for excellent performance. That plan worked well in 2021, but it will not be as effective in 2022. Stay away from this area and put your money somewhere else. Q3 Summary. With these valuation concerns in mind, it would be remiss not to mention that Datadog continues to produce incredibly impressive fundamentals each quarter, and that one of the reasons the stock's fallout from peaks has been relatively more benign than some other tech names. Many momentum stocks are down 40 to 50% from highs, if not more, is that its most recent earnings quarter, Q3, showed the usual fanfare with massive earnings beats and very optimistic guidance. Datadog's revenue increased by 75% year-over-year to $270.5 million in Q3. Few companies reach a $1 billion annual revenue run rate, let alone continue to expand at a greater than 70% YY rate after they do. It easily outperformed Wall Street's projections of $247.8 million, plus 60% YY, by a factor of 15. It's also worth noting that Datadog managed to increase revenue growth from 67% YY in Q2 to 77% YY in Q3. Datadog's Q4 forecast was equally stunning. As indicated in the graph below, the company expects revenue of $290–292 million, representing a 63 to 65% year-over-year increase. Datadog's gross margins have dipped slightly, which is a crack in the armor. Pro forma gross margins of 78% are 1 percentage point lower than the prior year quarter, while YTD gross margins of 77% are 2 percentage points lower. Despite this, the company remains on the high end of most SaaS competitors. Economies of scale on sales and marketing costs, Datadog's largest expense area, as it is for most software firms, have also aided the company's total profitability. Pro forma operating margins of 16% increased 7 percentage points year-over-year from 9% in the previous quarter, and 3 percentage points sequentially from 13% in the previous quarter. When we consider that Datadog is expanding sales at a rate of more than 70% year-over-year while maintaining an operating profit margin in the mid-teens, we have to admit that some of Datadog's premium is well deserved. Most software businesses struggle to meet the rule of 40, but Datadog is in a class by itself, having achieved the rule of 80. Conclusion: no one can deny that Datadog is a unique tale in the software industry, but with the stock trading at an insane greater than 31x forecast sales multiple, we believe this is already accounted for in the current stock price. Given how wary investors have become of risk assets in recent months, I believe the best course of action is to remain on the sidelines.